Chapter 8. Why Everyone Loves Moody's. In September 20, Dun & Bradstreet, a sleepy year-old business information company, spawned a sleepy subsidiary. The subsidiary was Moody's, the credit rating agency, which Dun & Bradstreet had owned since in 1962 and which has just hit the secondary market itself. Along with its two competitors, Standard & Poor's and Fitch Ratings, Moody's was the business of gauging the possibility that a bond would be repaid at one time in a fault. It did so by using a series of letter grades, now a ratings. A highest investment grade rating AAA meant that the bond had the same risks on the federal treasury bond. Almost not both rated AA to BBB minus were all investment grade, riskier than AAA is. But still saying no for widows and orphans. Anything below a BBB minus was a junk bond, considered too risky to be bought by pension funds and another institutional investors that were legally bound to have only safe investment. The business of rating bonds was a study, and the thing could be everybody used the three rating agencies and everybody understood what the two letter grades represent on the risk spectrum. In the most prospectus issued prior to becoming a public company, Moody's boasted that I rated 30 trillion of the world's debt across 100 countries. Steady, however, is not the same as fast-growing. Chuck is what immensely profitable. Moody's in 1999 revenues and the 64 million will have a barely tended to the fortune 20 years, much the less fortune when is this stock began trading. More investor yawned were Buffett, who always liked to buy stock other overlooked to the 50% stake in the Moody's, but that was mainly because he liked to the company's impregnable market position and its steady cash flow. Moody's has begun rating structured financial products, Wall Street, cash housing for mortgage-backed securities, off-balance sheet vehicles, derivatives, and the like. FSB were doing to the same, although Moody's had been too reluctant to rate mortgage-backed securities when first approached by the Leo Ranieri in the 1918 that the reluctance was long gone. By the time Moody's became a standalone company, its structured finance business was growing much faster than the traditional bond rating business. Structured financial products we need more than just a rating. They needed a high rating. The whole purpose of the asset-backed security was to check assets to could never merit a AAA rating on their own and transform them into products safe enough to be rated highly. AAA security could be bought by investors like money market funds and the pension funds. They could be used by banks to reduce capital requirements. The combination of tranching, where is a case in levels of risks that use the riskier tranche in the capital structure to protect the higher rated tranches. The rating of the agency had always been stingy about bestowing AAA status to corporate debt in 1908. In the early years, the security performed well. That was true even of the relatively small batch on the asset-backed securities that used subprime mortgage. They had plenty of the credit achievement, and besides, housing prices were going up to the way they were supposed to, which kept default to a minimum. But the rating agencies continued to slap their AAAs. And subprime securities went to the underrating, deteriorated, and the housing bond turned into an outer bubble. went to board. When it did, boards to the rating agencies and the investors who had depended on them were caught flat-footed. John Moody, the founder of Moody's, was a muckraking journalist who in 19 published something called Moody's Manual on the Industrial and Miscellaneous Securities. This publication, which investors took to immediately formed to the origin Moody's and first offered statistical information about stock, then Moody began adding analysis, ranking stock with the letter grades. Finally, he shifted his focus from stock to the bonds. This was his eureka moment. There had always been the less information available to a bond that stock bonds don't trade on public exchange, and most information about them is held by the investment bankers and the traders who are trying to sell them. The credit rating business didn't change much until to the 1979 when two things happened. First, the rating agencies they included a smaller upstart, Fitch Ratings, opponent the way they generate revenue, abandoning the subscriber model in favor of charging issuers directly. The switch made undeniable business sense. But ratings had become important enough that many investors wouldn't buy and real estate bonds creation were always going to be optional for the subscriber, for a rating had become mandatory issues. The rating agencies' business model came with an obvious conflict, now that they were paying by fund issuers. For a long time, the potential conflict had kept Moody and FT from taking to the step. We obviously cannot expect payment for rating a bond to do so would attach a price to the process, and we could not escape the share, which would understandably come that our rating are for sale. By the time mortgage-backed security arrived to the scene, ratings were ingrained in the verified and the capital markets. Lender put rating trigger in the borrower agreements. The stipulation that rating that right could account then payment to accelerate the collateral to come due. The government had literally hundreds of rules based on rating. One said that 95% of the bonds held by low-risk money market funds had to have an investment-grade rating. As well intentioned as many of their rules were. The overlooked two problem, the first is that the bond market was essentially outsourcing its risk management to the rating agencies. The universal acceptance of the rating resulted in almost no independent research by the fund manager, who actually bought the bonds. They simply assumed that the rating agency had given a bond a double A or triple A. It must be safe, nor was this under dark secret. Second, the rules involved the rating agencies with almost by biblical authority. The borrower phrase first used in 1968 by the New York City's finance administrator Ruth Goodman, but that the authority wasn't remotely deserved. That agencies are charged a study showing that their ratings were accurate a very high percentage at the time. The critics like Pernick, the fact ratings carried the false laws playing a trouble paradox, even as proof piled up to the agencies made mistake after mistake. Their power continued to grow. In retrospect, the surprise is not that the rating agencies will eventually be corrupted by the business model, but that it took too long to happen. But many years, whatever mistake they made were the results of misguided analysis, now out and out cravenness. Credit analysts on Moody Wits didn't worry about the revenue that might be lost if they refused to give an issue to the rating itself. That was someone else's problem. In the early 1990s, Moody's actually refused to rate a 10 popular structured products underground, and the rating might alert investors that expect more than they were likely to get. When I started there, I don't think Moody's managers knew what their market share was, said one former employee. By the peak of the prime, there were regular emails every time Moody's didn't get a deal. Another former managing director says the Clarkson used it to tell people, "We were in the business and we have to pay attention to market share. If you ignore market share, I will fire you." When I joined Moody's in 1997, Mark Proeba told investigators in analysts' warfare was the would contribute to the assignment and the rating that was wrong, damaging Moody's reputation for getting the answer right, and they lost his job as a result. When I left Moody's, an analyst's words, fear was that he would to do something that would for impairing Moody's revenue and the damaging Moody's relationship with the clients, and lost his job and the result. The great advantage insurance had in the seeking AAA rating and that they rarely needed, and the three agencies to involve in any one deal investor, like having two agencies rate a deal but nobody cared about having all the three involved, so each hour could play to the agencies and each other. They didn't really care which rating agency bestowed the rating. All that mattered was the rating itself. The AAA was the brand of Moody's, says a former Moody's structured finance managing director. Like everyone else, utilizing Reich's model, a given mortgage bucket that might contain as many as 1,000 mortgages. The working assumption was his home price dropping in California. They would remain stable and even keep rising in the other parts of the country. The Wall Street termed the spreading risks this way, and there are more complex variants. The closer in the mortgage-backed security came to zero correlation, the greater percentage of the tranche that could be labeled AAA underwriter on the other credit assignment to the best percentage of AAA tranche. One obvious flaw in the approach is that nowhere in the process was anyone required to the country real world to do the diligence about to the underlying mortgage. Whatever level of risks they desired, but TDOs were fraught with the risks and conflicts. And that's what's been using to buy debt. CDO managers were paying a percentage on the money, and the CDOs meeting they had an incentive to find stuff to buy. Good, bad, indifferent. Western firms who usually work hand in glove with the manager could earn hefty fees according to the one age from the manager who became and the big investor in CDOs as much percent to the cash flow generated for the set in CDO went to apply to the banker, to the CDO managers, the rating agencies, and the other who locked to the office. What's more, CDOs could also get banks and Wall Street securities firm but to the means and the motive to move their world's assets for other balance sheets and into a CDO instead. And since the rating agencies could be counting on the rate of being shook on the CDO AAA, nobody would be the wiser. It is a surprise to learn that just a rating agency has filed to snip overrun and WorldCom. They also drastically misused the first batch of the workforce to the downgrade hundreds of CDOs. It's no small part because they contained the bonds and certain companies. The agency has also was misused He handled investors to the CDO managers and the firms that had underwritten that, but because the CDO's influence was a still small, neither the lazy to the loss made headlines for a short while CDO balloon declined. In how did Wall Street respond? By devising a new type of CDOs, no one that won't be backed no buy corporate loans for mortgage-backed securities. The idea says that one person who was prominent in the CDO business was that originally rationally for CDOs, loan diversification had proven to the flawed. When you bought real estate, he says, you were golden, you were safe. There were a few critical differences between CDOs composed on securities mortgage and the CDOs composed of corporate loans to the firm contained not 2 but 3 levels of debt instead merely using debt but the debt accompanying CDOs were using debt to buy to the firm a pooled mortgage, which was she said, however, a second critical difference was the bonds package, but the mortgage generally had higher yields than the similarly rated corporate bonds. Defenders and mortgage-backed securities tend to explain away to the anomaly once again by claiming that investors didn't understand markets, package bonds, and weak corporation bonds, and they demanded a higher yield for that were really a very safe asset. And to be sure, that was one possibility. Another possibility too was that the market understood quiet while the mortgage-backed security were riskier than corporate bonds and they were compensating by insisting on the higher yield. Wall Street didn't really care which explanation was correct. All it cared about this data discovered an anomaly and could take advantage on the end. And did it ever? First bought mortgage-backed bond with the very highest yields they could find and reassembled them into a new CDOs. The original bonds didn't even have to be AAA. They could be lower rated securities that once reassembled into a new CDOs would wind up and without a much 50% and tranche rated AAA. Son, CDO managers were buying to the lowest investment rate at range the mortgage-backed security that they could find and they putting the new CDOs once this started to happen. CDOs became a self-protecting machine like Lizos that won't stop dividing from the very beginnings on the mortgage-backed security business. Marketers had always had to work hard to find enough investors to buy to the lower rate strangers. The AAAs were easy to sell because investors around to the globe that they were illegally confined to the conservative investment or didn't want to hold to the capital gains at higher rates investment embraced the higher yield relative to the super safe rating. The BBB and B- tranches were harder sold, which are much smaller to the buyer jet CDOs. In time, CDOs became by far the biggest buyers in the BBB and the mortgage-backed security. Purchasing or resembling is astonishing. According to the presentation by Karen P.S. Shava, Western structured credit strategies among other consequences. This practice helped to perpetuate to the world's most dangerous securities because they were the ones that had highest yield relative to the rate rating. One Wall Street security would later liken to the CDOs to purify uranium until they get to the stuff that the most exotic. Lang Gibson, the former Merrill Lynch CDOs, research analyst, wrote a novel after the crisis, is a which character described as triple Bs were recycled. The rating agencies were the Veryhard and the Magnus. The entire device will have collapsed with their participation. Get the rating out to the door. That was it, said a former SB executive. Once a tranche of the over-mortgage backup security was Trump AAA, nobody ever went back to and reanalyze it, and the world rebounded into a CDO. We simply assumed AAA and AAA, says a former Moody's managing director who worked in CDOs. The analysts structured finance were working 12 until 15 hours a day. They made fraction to the pay or even junior investment banker. There were 4 more deals in the pipeline than they could possibly handle. Their weird owl helmet were growing so fast we couldn't keep staff, and we were grossly under rosters. In course, nobody had the time and the inclination to examine the actual mortgage upon which the entire edifice had been built. If they had done so, if they had taken a hard look to the subprime mortgage that were at the heart of the securities they were rating AAA, it would have meant to putting an end to the immensely profitable business. It seems to me that we had blinders on and never questioned to the information we were given. And former Moody executive letter wrote. By the 1905, Moody's market capitalization had grown to more 50 billion than they were roughly the same at Bear Stearns. Yet Bear Stearns had employees and 7 billion of revenue, while Moody has employees and 1.6 billion of revenue. Moody's operating margins were consistent and over 50%, making it one of the most profitable companies in existence. More profitable or margin business to the ExxonMobil to the Microsoft between the time it was spun into a public company in February 2007. Its stock horizon, the percent structured finance was approaching 15% of Moody revenue, up offering 4% in 1998. It accounted for pretty much a Moody growth. In August, Ryan Clarkson was named President Money, and the compensation that year $3.2 million.